Thank you, everyone, for joining us today. I'm James Fields, President of Klingenstein Fields Advisors. I'm glad you could join us on our first webinar of 2021. Joining me today for today's discussion is my partner and colleague, Maury Gilliard, our Director of Wealth Planning. For those who haven't met Maury, he and his team work with clients and their families to address a range of tax, estate, retirement, philanthropic, and other wealth planning needs. While we are living in difficult circumstances, we hope that everyone is doing well and staying safe and healthy. And we'll talk more in a few minutes about the impact that financial health can have on your physical and mental state, along with some tips on how to stay financially healthy. But before we do that, we'll do our traditional recap of what's going on in the United States and the financial and market implications. During this call, you can submit questions in one of two ways. If you are listening through your computer, there's a widget on the right side of the screen where you can submit questions, or you can email them to mildred.palo@klingenstein.com. That's MILDRED.PALO@KLINGENSTEIN.com. First, let's talk briefly about where we are in terms of COVID-19 and vaccination. The concerning news, of course, has been that we saw what appears to be a post-holiday surge in cases in all parts of the country. And as of yesterday, the end of January, there have been over 26 million cases in the United States, with 39,000 fatalities. If the CDC is correct that there are 3 undiagnosed cases for each positive case, approximately 100 million Americans have had COVID-19. As hospital capacity in many areas has been severely challenged, some states and cities have reinstituted restrictions to try and contain the virus. On the positive side, it appears that cases peaked 2 weeks ago in the United States, Canada, and the United Kingdom. Both Regeneron and Lilly have proven therapeutic treatments for those who do become severely ill from COVID-19, and the vaccines have been rolling out nationwide. Unfortunately, there have been issues in terms of vaccine distribution, with organization and efficiency varying greatly by state and locality. While supply is ramping up to meet demand, with Pfizer and Moderna releasing between 12 and 18 million doses weekly, obstacles have arisen regarding sufficiency and distribution of current supply, necessary equipment such as specialized syringes, and qualified personnel to administer the vaccine. President Biden's top priority is addressing the pandemic, and he has pledged to overhaul the federal government's response to it, and that he will continue on the path from the end of the last administration, such that 100 million vaccine doses will be administered by his 100th day in office. Further, he's ordered more doses, such that 300 million Americans may be able to be vaccinated by the end of the summer. And that is without the additional vaccines likely to be approved in the coming weeks from both AstraZeneca, which has already been approved in the UK and in Europe, and Johnson & Johnson, likely to be approved under an emergency authorization here in the next couple of weeks. While we still see the light at the end of the tunnel, economic news has been somewhat of a mixed bag. Holiday season consumer sales grew approximately 3% over the holiday period, according to MasterCard's Spending Pulse, driven primarily by online shopping, which grew 49% over 2019. At the end of last week, we got our first read on the fourth quarter of 2020 GDP, which grew at a robust 4%. On the jobs front, the change in non-farm payrolls dipped into the negative for the first time since April 2020 in December of 2020, dropping by 140,000 jobs versus the consensus estimate of a 50,000 job gain. But this past week, we saw an improvement in the jobs market, with continuing claims having been better than weekly new jobless claims have been. Most of the jobs lost were in the hospitality industry, as the resurgence of the pandemic has hit bars, restaurants, and other hospitality-related industries particularly hard. So what is ahead with the new administration and with Congress now nominally under control of the Democrats? We're going to tackle the question of Congress first. Post the Georgia election runoffs in early January, the Senate is evenly split between those who are Democrats or tend to ally themselves with the Democrats and the Republicans. In cases where the vote is tied, Vice President Harris will serve as a tie-breaking vote. In the House, the Democrats were net minus 9 seats, but retain a majority of 222 seats versus 211 seats for the Republicans. The majority does seem to be smoothing the path for the confirmation of Biden's nominees for senior government roles. And in fact, no nominees thus far have failed to be confirmed. However, while the Democrats are the controlling party in both the House and Senate, the margin is slim, and party members do not always vote along party lines. We hope and believe that these facts will mitigate the potential for radical policy and regulatory changes, but in fact will lead to more moderate and centrist moves. Let's talk a bit about where we see ahead in the near term for the new administration. At the top of the agenda is a proposed package totaling $1.9 trillion in aid and stimulus directly to individuals in response to the pandemic and state and local government support. The American Rescue Plan highlights you can see on this slide. The highlights include additional stimulus of $1,400, increased unemployment benefits, and other provisions targeted to individuals in need. In the pandemic response area, the American Rescue Plan would provide $170 billion in funding to reopen schools, $70 billion to expand testing and for a national vaccine program, and $160 billion in emergency paid leave funds for public health workers. The plan also includes $350 billion in funding assistance for state and local governments, plus funding for small businesses. The plan will most likely be subject to modifications as it works its way through Congress. And while we expect the program to pass, we believe it'll be much smaller than the current one proposed. In fact, 10 Republican senators have proposed a $600 billion bill that President Biden agreed to meet with them to discuss. However, if the budget reconciliation process is used to force the $1.9 trillion package through on a partisan basis, the tenor of future negotiations will be harmed. So what does this mean for markets and investments? Our view remains consistent that the next few quarters are likely to be volatile, but that the outlook for the year 2021 is quite promising. Although the majority of S&P 500 companies have yet to report their fourth quarter earnings, as of January 22nd, 86% of the companies that had reported positive earnings surprises, according to FactSet, which would be a record percentage if it holds true for all the companies reporting, and that bodes well. Earnings are projected to be strong, and with easy comparisons to the first two quarters of last year, when lockdowns were the norm, year-over-year growth is quite likely. Financial companies and technology companies were leaders on the good news, while energy, airlines, hotels, restaurants, and the leisure industry in general continue to be a drag on performance, a trend we expect to continue for some time. Overall, we continue to favor equities, particularly given the low yields on fixed income, with a 10-year Treasury yield in the 1.1% range, and the Federal Reserve committed to keeping rates low. With President Biden's focus currently on the pandemic, we do not expect corporate tax rates to go up in the near future, which is a positive for corporate earnings, although it is somewhat offset by the regulatory agenda that has been put forth through 40 executive orders and will likely be part of the legislative agenda. We continue to favor growth sectors, such as technology and healthcare, both of which stand to continue to benefit from the current and likely future environment. Last week, the January Federal Open Market Committee meeting of the Federal Reserve happened, and as expected, rates remained unchanged and are likely to remain that way for quite a while to bolster economic recovery through an easy money policy. The Fed also committed to increase Treasury purchases by $80 billion or more per month, and agency mortgage-backed securities by at least $40 billion per month for the foreseeable future. Thus, while we expect, as in any bull market, for a correction to happen at some point, we are biased towards equities, having good performance for this year. So with that, I'd like to hand it over to Maury for a discussion on how we can stay financially healthy and lower our stress levels, something we all want to do these days. Thank you.
Thanks, James. As many at KF Advisors know, this is a subject that is very important to me, and the beginning of the year is a great time to check to see if you are taking the most important steps to financial wellness. In fact, January is designated as National Financial Wellbeing Month. While we miss January by a day, there's still plenty of time to work on your financial fitness. Let's start with some interesting facts on just how linked financial, physical, and mental well-being are to one another. Americans, as a rule, tend to stress, whether it's about their personal lives, their careers, you name it. And the current environment has only exacerbated it. But even before COVID, the number one thing Americans stressed about most was their finances. This is true across all age groups, with the exception of Gen Z, where the future is their overriding stress contributor, followed by career and finances. And stress can take a high toll on our mental health and make it difficult to focus and be productive. This stress can manifest itself in a number of ways, ranging from being angry and irritable to depression. Financial stress can take a toll on your marriage, your job, memory, self-image, motivation, and energy level as well. In addition, financial stress impacts our physical health and can lead to a variety of health problems, from migraines to heart disease. As you can see from the chart on the screen, which looks at the differences between those with low debt stress and high debt stress. And of course, COVID has not helped. A MetLife study released early in the pandemic found that 52% of employees were concerned about their financial health due to the pandemic. Even prior to COVID, 43% of employees who did not consider themselves financially healthy cited that their lack of financial stability as a reason for not rating themselves more mentally healthy. Near-term concerns due to COVID were the top reasons employees considered themselves in poor financial health. By taking some simple actions, however, you can improve your financial health. And an important first step is to look closely at one's financial state and honestly assess whether you are on a positive financial path. This can be a difficult exercise, but the consequences of living in uncertainty contribute to the financial, physical, and mental stress we are discussing. Consulting with Klingenstein Fields Advisors and your legal and tax experts can help to build an objective picture of your financial status and alleviate some of that stress. Regardless of the state of your financial well-being, there are steps we can all take to make sure we stay on track to be as financially healthy as possible, starting with setting a budget that you can stick to, where you save for the future needs that you know will be occurring, reduce excess or unnecessary expenditures that are dragging down your finances, recognize there will be unexpected expenditures and set a budget for them, and prioritize your spending. For instance, if buying a vacation home is the most important goal, plan for that first. Similarly, if early retirement is your objective, put that at the top of the list. We are here to help and work with you to determine these needs and goals. Then, through your investment policy statement, we can develop a roadmap to achieving your objectives in light of your feelings about risk, your circumstances, and investment constraints, and the prioritization of your goals. It's also important to recognize that this is an extraordinarily stressful time in every way, and that we need to take time to participate in stress-reducing activities, which is something we have been encouraging everyone at KF Advisors to do. These might include taking action to be better organized. Personal financial management is one of those skills that comes easily for many and is impossible for others. But over and over again, we find that improving organizational skills surrounding money is freeing. And banks and credit card companies make this even easier these days by itemizing through categories for further clarity. Budgeting and financial understanding creates clearer course of action, period. Next, take time to practice some self-care, such as exercise, going for a walk, getting to sleep earlier, or meeting virtually with friends. When you're feeling stressed, take a break and try to relax. You may find a few minutes away can help you see the problem more clearly and that it's not as big a deal as you thought. A related point being that as a society, those working from home over the last year have had an improved quality of life in ways. But working from home also reduces the ability to disconnect from the job. The risk of burning out is real, so remembering to take time for yourself is critical. Talk to others for mutual support. You'll feel better because you've gotten encouragement and because you've helped someone else too. And finally, Klingenstein Fields Advisors is here to help in any way that we can. We've talked to many clients over the past 10 months about how to deal with the financial uncertainty they may be experiencing in the current environment. And with that, back to you, James.
Thank you, Mari, and thank you everyone for listening. This is a time when I've spoken to many clients, colleagues, and friends who are feeling the stress of living through a pandemic, and I agree that a mutual support is a great way to help one another through this. We hope that this discussion was helpful. We encourage you to continue to reach out to us with any questions you may have. We will continue to monitor the situation and developments carefully, and of course, keep you informed. We always welcome the opportunity to discuss our thinking and approach. We encourage you to reach out to your advisor with any questions on your individual portfolio. At this time, we'd like to open up the call to questions. Again, if you're listening through a computer, you can submit questions to the widget on the right side of your screen. Or you can email any questions to mildred.palo@klingenstein.com. That's mildred.palo@klingenstein.com. Thank you.
Great, thanks, James. We have a number of really good questions, so I'm going to start right off. First one for you, and it was really about your 2021 market view and outlook. If you could maybe talk a little bit more. You mentioned, a potential correction, kind of what you see in terms of magnitude and maybe timing, if you have any thoughts on that.
Sure. Our job is inherently to predict the future, which is impossible, but I certainly would say this. There's a lot of things to be concerned about, one of which we hear a great deal about is valuation, for example. But historically speaking, a bull market, which we've been in, does not end just because of valuation. Our two biggest concerns, frankly, Ellen, are inflation, and then, of course, any change in the trajectory of the pandemic. Starting with the second one, to the extent that any of these variants turn out to be more virulent, turn out that none of the vaccines are effective against them, or that the therapeutics that have been so successful in recent months have no efficacy, and it tends to spread, that would be of great concern, because that may lead to a lockdown or a resurgence in the lockdowns of the economy, which will have negative effects on earnings and on company profits. The second one, which is of greater concern and generally leads to most ends of most bull markets, is inflation and the reaction to inflation. Certainly, we've seen inflation tick up a little bit, but of course, the Federal Reserve has changed its stance on inflation in the last few months and expressed a willingness to allow inflation to run higher and hotter than the historical 2% mark in order to get the economy growing. On the other hand, we will have an interesting occurrence likely in April when the year-over-year inflation numbers, again on an annual basis, will look historically large, because as we all know, last April, the economy shrank. We had deflation. And so while we believe the market will likely shrug that off and understand the anomalous 1 month timing as last year's numbers roll off for March and April, there is a chance that at least the headline news will spook some investors. But generally speaking, it is inflation and therefore the increase in interest rates to quell that inflation that historically ends bull markets. And many of the leading economists from Goldman Sachs, Morgan Stanley, the Fed, and even the CBO believe that we'll have mid-single digits growth this year and low single digits growth next year, mostly because the economy will continue to grow off of the lows of last year, and we'll continue to have both easy monetary policy and likely stimulative fiscal policy.
Great, thanks, James. Next question is for you, Mari.
Great.
Prior to election, obviously, a big part of President Biden's platform was a tax program change in policy, pretty significant. How likely do you see tax policy changing in the near term? And is there anything that we should be doing investment-wise or giving-wise to address that in the near term?
Okay, that's a great question. And, much has been said about the Biden administration's tax policy, proposed tax policy, I should say. Some of the different aspects of it were an adjustment to Social Security tax. If you make over $400,000, you are going to have to withhold an extra 6.2%, That's employer and employee. There's increase in marginal tax rate from 37% to 39.6%. There is, the corporate tax increase, 21 to 28. Capital gains tax proposal, in that if you were making over $1 million a year, your rate would be increased to 39.6. A state tax exemption amount was potentially supposed to be changed from the current $11.7 million to half, if not less. And on top of that, there's been talk about step up in basis and the potential for that particular policy to be modified in some form or fashion. So big picture, I don't think that, near term, a change in tax policy is likely. I think the new administration has expressed that their focus is going to be on vaccine distribution and the virus itself. I think that any deviation away from that would seem a little tone deaf, to be quite honest. One really interesting note, last week, there was a top Biden tax policy aide who had talked about the idea of retroactive tax policy, something that a lot of people have feared. And when I say that, I mean that something gets done, let's say 3 months from now, and it's made effective as if it was Jan 1, 2021. So they said that's not something that they're looking into. And even if something were to happen down the road, there's the chances of that are slim to none, which as a planner, that's something that excited me in terms of giving people ample time to really address and react to changes in a thoughtful way and plan strategies accordingly.
Great. Thanks, Maury. The next question, I think it's one that's been on everybody's mind, and we've gotten it from a few people. So I'm going to toss this one out to both of you guys. We were talking about it earlier. What's going on with GameStop and AMC and other companies and Robinhood and that whole story. Do you think it's going to have a material effect on the market? Will it change how the market works now with smaller investors banding together and that topic? So great question. I think we're all interested in this one.
Yeah, it's
James.
It's a really
James,
good question.
want to go first? Or? Okay.
Sure. This is one that I feel like everyone's talking about, from elementary school kids like my children, through every other generation older than them, because it's become such a topic, even pushing the pandemic off of the top of the newspaper. It's very interesting, and it's a little complicated once you dig a little deeper. The high level of it, which is, as you noted in the formation of the question, Ellen, is a large number of retail investors banding together through chat rooms and other social media connections to drive the price of the stock in a unidirectional way. And in this particular case, a couple of stocks that otherwise, from a fundamental basis, companies that were in duress or distress and not doing well, and therefore have become very large short positions for some of the leading hedge funds. And what's intriguing about it is that these hedge funds, in fact, before Robinhood got involved and the Redditors, were short more than the entire capitalization of these companies, and much greater short interest than the float of those companies, which in theory should not be possible. So already there was something broken, so to speak, in the way that these short trades were set up. And then with the mass movement, the power of the crowds driving up these stocks, the short covering that many of these hedge funds had to do drove, in the case of Melvin, basically drove a large hedge fund bankrupt. What is interesting, and one of the reasons we do not recommend shorting stocks at Klingenstein Fields, is when you're short a stock, your potential for loss is much greater than if you're long a stock. And you are inherently borrowing or have to deliver that stock, and therefore there's implicit leverage in that type of investment. So it's not something that we generally do. That said, what caused the effects to go beyond GameStop, AMC, and others was that those same hedge funds that had to cover those shorts and buy back that stock had to find the cash from somewhere. And what they ended up doing was selling their winners, selling everything that was doing well. So the weight that came onto the market from those large investors selling everything else is what really had the effect go beyond GameStop. As to the longer term changes in market, I don't believe this will be a big change in market structure. The reason that some of the negative press from the small investors hit the brokerage community so hard was that when the brokerage community stopped allowing trades, stopped allowing buys, at least of any size you wanted, that then, of course, benefited the short sellers. But the reason for that has to do with really the plumbing and the way that the financial markets work. And had it been a larger institution that was the market maker rather than a technology startup such as Robinhood, it would have been a lot more capital available to support those trades. But because it was Robinhood, they had limited capital to support those trades through the clearing operations that really are the plumbing of the financial markets. And I think you'll see some changes in regulation around that. And I think you'll see some things that will be to the benefit of the small investor. But historically speaking, there have been other manias like this before. And I think you will certainly see them again, particularly in an environment with easy money. Mari, I don't know what you would add. That was long-winded. I apologize.
No, it's okay. It's all right. We're of the same mind. I think it's one of the strangest weeks in recent memory. I should say a continuation of it today at a smaller scale, but it's indicative of the power of the retail investor. I think notably the SEC made some comments around monitoring the activity in the future and saying they'll take aggressive enforcement action if they find there's market manipulation. They also talked about their role to protect the retail investor from any abusive or manipulative behavior. So big takeaways for me, two major concerns I had in reading a lot of the information, which we all have. One is the little guy, the quote unquote little guy getting blown up in the end. When I say that, I mean amateur investors who don't have a lot of background in it, in trading itself, even though they have the right to lose money just like everybody else. I had concerns in a lot of them being left in some of these trades. On top of that, my concern is the potential erosion of investor confidence. When you think about these names, a lot of examples of companies with little to no earnings, a lot of debt, terrible future trends, and you see them skyrocket, people think, what's wrong? And James, you alluded to this. It's something where you don't want folks to think there's a dislocation across the board when it could be something that's very localized. I've thought it's been a funny thing just in terms of the whole saga and how it's united lawmakers across the aisle in common cause, which is bizarre, but also encouraging. Longer term, I think that it's not the death of the short sale, and I imagine that there'll be some type of regulation put in place to try to minimize the impact of this sort of phenomenon in the future. In terms of the way we do business, I don't think anything's going to change, obviously, but I think some of the hedge funds out there, they may near term think about deleveraging a bit. And that's my 2 cents.
Great answers. Great question. I know we've all been watching it, as I said, with fascination, and we'll continue to watch. Mari, I'm going to impose on you again with another great question. You talked a lot about sort of the effects that financial stress is having on mental health and things you can do to improve both. Any other things you would like to add, particularly on the mental health side? Everybody is definitely feeling stressed, and this is a big concern.
Sure. I'll put on my Dr. Phil hat. I would say in addition to some of the things I talked about on the slides, I would add sleep and nutrition and staying active. I think that we're in a place where not enough people are taking vacation, and that's really a big one. I think a lot of people are out there wondering why they feel a little run down, a little exhausted, and it's because we haven't really stopped. And I have a problem with this myself. I think we feel that we're not actually going anywhere. So, why take the vacation day? But I think a lot of people out there need it. And, on top of that, I would say that we should try where we can to avoid certain stress triggers. So, perfect example, I have a really good friend who the other day told me, I don't talk about politics anymore. He said, I found out that, anytime it comes up, it gets me upset. So I've decided that I'm done with it for a while. And I was pretty impressed. It was, he's more elevated than me, but it makes perfect sense. And that's sort of what I would add.
That's great advice. I'll have to remember that, especially with certain family members. Another question that I'm going to give to you, James. If you could talk a little bit about fixed income, maybe, given the outlook in terms of rates and what's going on with fixed income. Should I even be in fixed income at this point? What else should I be considering?
Sure. Well, it's a great question, and it's one we think of a lot. And it's sort of intriguing because with rates as low as they've been, you've actually seen tremendous fund flows into bond funds, particularly in the last few months, as there's been a flight to safety, the same way you've seen money moving into gold and other historically safe havens. As volatility increases and as people are concerned and as markets once again get near all-time highs as they were intraday last Tuesday, you've seen a flight to safety and a surprising amount of money moving into bonds. The answer we would think of is, generally speaking, not yield driven so much as it is what's the right asset allocation for a particular client. And as Mari mentioned in his part of the presentation, we start with an investment policy statement, which really is to understand client goals and objectives. And from that, we come up with an asset allocation that makes sense for that client. So what role does fixed income play in such an asset allocation? That will differ for everyone. Now, it is true in a higher yield environment, two things happen. Returns to equities aren't as good, and returns to fixed income, because the yields are higher, are better. Here, you don't have that currently, and we're not likely to have that for a number of years based on what the Federal Reserve has stated. So the returns to fixed income purely on a yield basis have been historically low. And so folks investing who need a fixed income have been challenged. And that's not just individuals, that's pension funds and others who need to have a fixed return to offset fixed liabilities that they have. And that is a great concern. So there are reasons to own fixed income. It can be, it's ballast to windward. It's something that gives you what people say, sleeping at night. It helps you knowing that there's going to be no volatility. A lot of it has to do with what are your goals and objectives, and also your tolerance for risk. And in this case, I mean risk in terms of volatility. We have many clients who look at their portfolio every day, multiple times a day, and on days like the end of last week when the markets are down substantially, it affects their mental health. It affects their well-being. It makes them uncomfortable or nervous, even though those losses are not realized and even though it's just one day. So if volatility is uncomfortable, the more of your portfolio that is in non-volatile asset classes, such as fixed income, the better. So it's really a personal question for each client situation, but it's certainly the case that all else equal, we would be biased against fixed income because of the low returns we're expecting. And frankly, since rates are so low, they're more than likely to go up from here, whenever that may be. And in a rising rate environment, existing low yield securities will do very poorly. And you can likely lose more money on the face value of the fixed income securities than you've ever made in the interest.
Great, thanks. Next question, another great question, and I'm going to give that to you, Mari. When you're helping clients plan, given the current environment, how do you help them determine what the appropriate cash or liquidity level is at this time?
Sure. So that's something that comes up, weekly. I think when we're talking about what is the right amount of cash for a particular client, we usually have a conversation about near-term need. We have conversations about non-recurring goals, and a portion of that is risk tolerance. I think for many clients, it ends up being a peace of mind decision, but there's not a lot of alternatives, that in terms of when we think of cash and we think of yield, as James mentioned, cash, fixed income, it's not great right now. So it's obviously less advantageous in terms of return to have large cash positions at this time. And it's funny because when the market's doing great, we want as little as possible, but because we'd rather have it invested. And when the opposite occurs, we have a lot of clients who like to see the liquidity, even though it doesn't make financial sense. So while we try to think in terms of like emergency reserves, and this is something I think I talked about on a webinar a few back, in terms of 3 to 6 months of cash on hand for emergencies and cushion, it's a question that is unique to the individual and something we'd be more than happy to talk about to try to find a tax efficient solution.
Great, thanks. Next question, I'm going to throw to you, James, and this is about the dollar sort of outlook based on administration, what's going on internationally versus in the U.S., and sort of your view on international and emerging markets. Excuse me.
Yeah, thank you, Ellen, and it's a good question. We're certainly not currency experts, but currency trading is driven by a number of things, and it's a relative value trade, which means while we can talk about things that we can do domestically that should affect the value of the dollar, it's really what the dollar does relatively to other large currencies that's of import here. So I think when you think about current policies in the United States, Federal Reserve policy keeping interest rates low, which means owning dollar assets is relatively low. If you're owning, let's say, treasuries, for example, which is the primary way that foreign investors invest in the United States. And at the same time, if you think about huge budget deficits the last few years, and increasingly likelihood of huge budget deficits going forward, at some point, historically speaking, that will force an increase in interest rates in the United States, which of course would make the return to dollar assets improve. The two other primary ways that foreign money flows into the United States is into our stock markets. And again, we've seen that continue over the last 11 years. One of the big drivers of U.S. equities has been foreign investment in U.S. equities. We've been the best market, historically speaking. The dollar is the safest and most stable currency. So if you're in most other geographies, there's value to investing in U.S. dollar-based assets, and particularly in U.S. dollar-based equities. And the third one, which has been not as big an issue, particularly since the pandemic started, is foreign money flowing in and buying U.S. businesses. Whether those are startups investing through venture capital or actually large foreign companies buying U.S. companies. I think we're going to continue to see those factors drive a moderate dollar. So I think you're going to have, on the one hand, low interest rates that are likely to continue, weaken the dollar, and the sense that there'll be a lot of spending and a lot of internal focus. At the same time, I do believe that as we believe the U.S. equity markets will remain strong, that there'll be a flow of funds from an investment perspective into the United States. And as there is dislocation in other parts of the world, there's a value of just owning dollar assets because of its stability. So I do think that the dollar will not have big moves in either direction. But again, I'm no currency expert.
Thanks, James. All right, we have time for a couple more questions. I'm going to throw the next one out to either of you or both of you. You talked a little bit about some of the hardest hit sectors, obviously leisure, travel, restaurants. They're still suffering during the pandemic and the restrictions going on. Do you think they will come back? Is this a fundamental shift in this particular area? And if they are going to come back, when? So what do you think is the timing?
I'll let you go first this time if you want, Mark.
Okay, sure. So I would say this is directly linked to vaccine distribution. If the numbers ramp up and we get good news as it relates to new vaccine producers and effectiveness, I think the timetable for a lot of these hardest hit sectors will accelerate in terms of when they come back. If we get bad news and there's some of these variants, as James had mentioned during his piece, end up being a little nasty and delay things, obviously it will delay the period of time which we are, completely open again.
I would agree with that it's the virus, the vaccines, therapeutics, the response to the virus that will drive the ultimate answer to that question. I do think, though, within hospitality, there are some differences. You've seen, for example, restaurants and hotels have been driven very much by local response and local economic and governmental response to the virus. So, for example, in a number of states, let's say in the South and the Midwest, you've had very little in terms of economic decline. And in some of the other states, including where we are in the Northeast and in California and some others, where you've had a much more dramatic decrease in the hospitality industry and in the economies in general, as the responses there were different. That's not to make a judgment call, it's just the responses were different, and therefore the impact on those businesses was different. There are some businesses, though, that I think, for example, cruise lines, that are, regardless of your locality, feel like something that's going to take longer to get there. And to Mari's point, you're going to have a lot greater herd immunity vaccinations than others before people are comfortable doing that. However, if you rewind, when we thought the pandemic would last 3 or 4 months earlier last year, there was a period of time when cruise lines started to open up booking for last August, and they were overwhelmed with interest. And I think what you are going to see is when it does open, there'll be dramatic interest for the reasons Mari mentioned. People are going to want to take that vacation. They're going to want to not be locked at home with their families, for sure. So you'll see that.
I agree.
The other piece of it, which came up today, is that there are a number of countries such as ours, and we're all lucky for so many reasons to live in the United States, where we're likely at some point in 2021 to have everyone vaccinated who wants to be vaccinated. But many parts of the world will not be so lucky. And because of that, you may have a great increase in domestic travel or limited travel to other countries that have done a good job, but you're likely to continue to see the real opening of global travel and all the hospitality industries related to that take a lot longer. And it may take till 2022, 2023 until everyone who wants to be vaccinated globally has an opportunity to do that.
Great answer. That's something I don't think most people haven't thought about. All right, last question. And for anyone whose question we didn't get to, thank you. Someone will definitely reach out to you. And if you think of questions, reach out to your advisor. That's what we're here for. But the last one is a kind of a general one. Just, given the last year, and we are coming up on almost a year next month that we've been in this very extreme and strange situation, has it changed the way that you plan and you invest? And do you think that's a permanent and fundamental change, or is it more tactical? And I'm going to open it up to both you guys.
You want me to go first?
Sure. And then I'll answer and wrap it up for everyone.
That's perfect. So I would say, and hopefully James is of the same mind, I would say fundamentally fundamentally we're doing what we've always done. We're opportunistically looking for undervalued names. The past year, techie growth names have driven the day, but it's not changed the way we evaluate companies. We consider fundamentals and management and valuation metrics and catalyst and risk within the industry, and I think that's going to continue.
Yeah, fortunately, I already agree with that. What I would add is that we are going to continue doing what we've been doing. However, we have learned some things. So, for example, we were able to all seamlessly start working from home. And if you look at the census of our firm, we cover 5 generations of professionals. And so I think we've been pleasantly surprised by that. That's also informed some of our investing in, not in terms of how we look at investing. Mars is 100% correct. That has not changed. But we, like everyone else, have become more adept at recognizing trends, changes, and have a view that some of the most dangerous words in our profession, which is, this time it'll be different. We do think there are changes fundamentally in the economy and the structure of the economy where technology-enabled work, and as we discussed earlier, technology-enabled investing for the little guy, does change some industries and does change where future growth and future opportunities may come from. So our way of looking at companies has not changed. Our way of looking at managers has not changed. But we do think that, the world will continue to move faster and faster, and that technology-enabled businesses of any kind in any sector will continue to drive growth. Thank you, everyone, for joining us today. Again, as Ellen mentioned, if there are questions we didn't get to, and I'm sure there are, someone from our firm will reach out to you to answer them. And everyone stay safe. And for those in the Northeast, enjoy the snow.